AppLovin is up over 52% year to date in 2025. And of course, I'm happy about that. I've had this stock rated as a buy. But investors are asking me, what do I think about the company now? The company's up already significantly year to date, and it has yet to fully ramp up the launch of the e-commerce segment of its business. Of course, it's thriving on the gaming side of the business, but the e-commerce side remains a question mark for investors. So in this video, I'm going to review the company's latest progress and update my recommendation of AppLovin stock. I'll share with you my proprietary discounted cash flow valuation for this company so you can see what I calculated as a fair value. I'll also share with you the forward price to earnings ratio so we can see the stock's valuation on a forward PE multiple. I'll do all of that in this relatively short video, so let's jump right into it. So AppLovin's management team in the most recent quarterly conference call with Wall Street analysts said that based on all the opportunity in front of us in our core market, we are confident we can sustain 20% to 30% year-over-year growth driven by just gaming. So that's not even including the upcoming e-commerce segment that will justify a increase in the company's revenue growth rates. But just within the gaming market, they expect 20 to 30% growth. And with the company that's generating adjusted EBITDA margins approaching 80%, this kind of revenue growth is very lucrative for long-term investors. So during the most recent quarter, the company said that revenue increased by a very healthy 77% from last year, reaching approximately 1.26 billion, while adjusted EBITDA nearly doubled to an impressive 1.02 billion. That's good for a margin of 81% adjusted EBITDA. Remember, EBITDA stands for earnings before interest, taxes, depreciation, and amortization, and it's a proxy for cash flow because some of those costs are non-cash expenses, things like depreciation, amortization. Sometimes interest expense can be non-cash, and then adjusted EBITDA further adjusts that figure, which is an already adjusted figure, to remove non-cash expenses like stock-based compensation. The management team saying that the majority of their revenue growth in the quarter was driven by their core gaming business. Still, with the e-commerce segment, it performs well, but they're limiting onboarding of new customers to focus on the preparation for the self-serve launch in the fourth quarter. Click the link below to watch the full video.